There is a final promise that underpins the entire philosophy of the world's greatest investor. It's not a promise of guaranteed riches, or of a secret formula that unlocks the market's code. It is a promise of clarity in a world deliberately engineered to be confusing. It's a promise that the greatest financial dangers you will ever face will not come from a sudden market crash or a recession, but from a place you'd least expect it: the alluring fog of complexity. Warren Buffett, over a 70-year career of unparalleled success, has built his entire fortune not on understanding the complex, but on the disciplined and ruthless avoidance of it. He has taught us that in the world of money, the most sophisticated tool is not a powerful algorithm or a convoluted financial derivative, but a simple, piercing question: can I explain this business, how it makes money, and why it will be making more in 10 years, in a single paragraph that a reasonably intelligent person can understand? If the answer is no, he walks away. He doesn't try to get smarter. He doesn't hire a team of PhDs to decipher it. He simply puts it in the too hard pile and moves on. This isn't a sign of intellectual laziness. It is the very hallmark of genius. Because what Buffett understands at a level deeper than almost anyone else is that complexity is often a cloak. It's a shield used by the incompetent to hide their lack of a viable business model, and a weapon used by the malicious to hide their fraud. Today, we are not just going to study this principle, we are going to forge it into a weapon for your own financial arsenal. We are going to deconstruct this core idea, this final promise of clarity, into a system you can use to avoid financial disaster, to identify honest, durable companies, and to chart a course toward genuine financial freedom. This is not about learning a new stock tip. It is about upgrading your mental software to see the world of business and investing as it truly is, stripped of the jargon and the hype. It is about learning to trust the beautiful, powerful, and profitable engine of simplicity. Our journey begins with the foundational pillar of Buffett's entire worldview, the bedrock upon which all his other decisions rest. It's an idea so simple it feels almost trivial, yet its mastery is what separates the amateur from the professional, the speculator from the intelligent investor. It is the concept of the circle of competence, which is, at its heart, about the profound power of saying no. It's not about how much you know. It's about how honest you are about what you don't know. To truly grasp its significance, we must travel back in time to the late 1990s, a period of wild euphoria, a time when it seemed a new era of economics had dawned, and Warren Buffett, the Oracle of Omaha, looked like a relic, a dinosaur blissfully unaware of the comet hurtling towards him. The air was thick with the promise of the internet. The Nasdaq was a rocket ship, soaring past 3,000, then 4,000, then 5,000. Companies with no profits, no revenues, and sometimes no finished product were achieving billion-dollar valuations overnight. Names like Pets.com, Webvan, and TheGlobe.com were the talk of Wall Street. It was the dot-com bubble, and if you weren't in, you were a fool. And by all accounts, Warren Buffett was the biggest fool of them all. For years, Berkshire Hathaway had been a juggernaut, but now it was lagging. While the Nasdaq doubled and then doubled again, Berkshire's stock price languished. The media, once fawning, turned vicious. A cover story in Barron's in 1999, titled "What's Wrong, Warren?" portrayed him as an aging icon, hopelessly out of touch, a man who had lost his magic. The article was brutal, detailing how an investment in Berkshire had underperformed a simple S&P 500 index fund for years. The pressure was immense. His own shareholders were restless. His friends were concerned. The entire world was screaming at him that he was missing the biggest wealth creation event in human history. They urged him to invest in technology, to buy into the new economy. He was friends with Bill Gates, he had a front-row seat to the revolution, yet he refused to buy a single share of these high-flying tech darlings. His reason was maddeningly simple. In interview after interview, he repeated the same refrain. Quote, "I don't understand them." He would explain, "I know what a stick of chewing gum is going to be doing in 10 years, and I don't know what Microsoft is going to be doing in 10 or 20 years. He wasn't saying these companies were bad investments. He was simply stating, with a profound and unshakable humility, that they fell outside his circle of competence. He couldn't, with any degree of certainty, project their earnings and cash flows a decade into the future. He couldn't explain their competitive advantages in a way that was durable. He understood brand names, like Coca-Cola. He understood insurance, like Geico. He understood railroads, like BNSF. But the intricate workings of network effects, software upgrade cycles, and rapidly changing technological landscapes, that was in his too-hard pile. He was publicly and painfully choosing to look foolish in the short term rather than risk being proven a fool in the long term. He said no, not just once, but every single day, for years, as the bubble inflated to grotesque proportions. And then, in March of 2000, the bubble burst. The Nasdaq, which had peaked above 5,000, began a catastrophic descent. By October of 2002, it had fallen nearly 80%, wiping out an estimated $5 trillion in market value. Pets.com, which had raised $82 million in an IPO, was liquidated. Webvan, which had been valued at over $1 billion, went bankrupt. The heroes of the new economy were exposed as emperors with no clothes. And Warren Buffett? While the world burned, Berkshire Hathaway thrived. His portfolio, filled with simple, understandable businesses, was a fortress of stability. He hadn't just avoided the crash, he had preserved his capital, ready to deploy it into the wreckage at bargain prices. His decision to say no was not a missed opportunity, it was his greatest triumph. He had defined the borders of his knowledge and had refused, under unimaginable pressure, to step outside of them. The psychological principle at play here is a powerful defense against one of the most pervasive cognitive biases that afflicts investors, the Dunning-Kruger effect. This is a cognitive bias whereby people with low ability at a task overestimate their ability. In essence, they are too incompetent to recognize their own incompetence. In a raging bull market, almost everyone becomes a victim of the Dunning-Kruger effect. When stocks are only going up, it's easy to confuse luck with skill. An investor buys a hot tech stock on a whim, it doubles in 3 months, and suddenly they feel like a genius. They believe they have a special insight, a unique understanding of the market. This feeling is amplified by the overconfidence bias, our tendency to be more confident in our own abilities than is objectively reasonable. This toxic cocktail of biases convinces the average person that they can pick winners in complex fields they know nothing about, whether it's biotechnology, semiconductor design, or enterprise software. Warren Buffett's circle of competence is a direct antidote to this. It's a conscious act of intellectual humility. It forces you to replace the question, "Could this be a big winner?" with the far more important question, "Do I truly understand why this would be a big winner and what could go wrong?" Buffett's genius is not that his circle is larger than everyone else's. In many areas, like technology, it is decidedly smaller. His genius is that he knows exactly where the perimeter of that circle is, and he never, ever allows himself to be lured outside of it by envy, greed, or social pressure. He operates from a position of what psychologist Daniel Kahneman calls epistemic humility, an awareness of the limits of one's own knowledge. This is a cerebral shield. When you define your circle, you are no longer susceptible to the siren song of the next big thing if it lies in uncharted territory for you. You can watch a stock like Nvidia triple and feel no FOMO, no fear of missing out, if you honestly admit you don't understand the long-term competitive dynamics of the GPU market. Your ego is detached from the outcome. This mental discipline prevents you from making the single biggest mistake in investing: venturing into territory where you are the patsy at the poker table. Every complex industry has its experts and its insiders. If you are investing without a deep, fundamental understanding, you are gambling, not investing, and the odds are permanently stacked against you. So how do you apply this principle in a practical, systematic way? You can use a mental model I call the 3-box system for due diligence. This is a blueprint for organizing your investment universe and focusing your intellectual energy where it matters most. Imagine 3 empty boxes in front of you. Box 1 is labeled, "I understand this inside and out." Box 2 is, "I partially understand but need more work." And box 3 is the most important of all, the too hard pile. Your first task as an intelligent investor, before you ever look at a stock chart or a PE ratio, is to start sorting every potential investment into one of these three boxes. Box 1 is for businesses that are squarely within your circle of competence. This could be because you work in the industry. If you're a software engineer, you have a massive informational edge in understanding software companies. If you're a doctor, you understand the healthcare business. But it also includes businesses that are so simple their models are universally understandable. Think of Hershey's. They make chocolate, people buy it. Their competitive advantage is a powerful brand name built over a century. The inputs are simple: cocoa, sugar. The process is simple, and the consumer demand is stable. You can, with a high degree of confidence, predict that people will still be eating Hershey's bars in 10 or 20 years. Box 1 is your hunting ground. This is where you should spend 95% of your time and analysis. Box 2 is for companies that intrigue you but are not immediately understandable. Maybe it's a company like Costco. You understand the retail model, but you need to do a deep dive into their membership model, their supply chain efficiency, their real estate strategy, and the unique culture that drives their success. These companies are knowable, but they require significant effort. You can move a company from Box 2 to Box 1, but only after you've done the rigorous work of financial analysis and due diligence required to master the subject. This requires reading years of annual reports, studying competitors, and truly understanding the industry's dynamics. Box 3, the too hard pile, is your brain's most important filter. This is where you aggressively and unapologetically place any business you do not quickly and intuitively grasp. A biotech firm developing a novel gene-editing therapy? For 99.9% of us, that goes straight into the too hard pile. A complex financial institution that deals in exotic derivatives? Too hard pile. A company whose financial statements are filled with footnotes you can't decipher? Too hard pile. The goal is not to have the smallest too hard pile. The goal is to be brutally honest with yourself. Following this blueprint for your personal investment strategy is transformative. It liberates you from the need to have an opinion on everything. It focuses your limited time and energy on areas where you can develop a genuine edge. It is the first and most critical step in avoiding the catastrophic losses that come from playing a game you don't understand. The antithesis to this disciplined approach is the path followed by the overwhelming majority of retail investors, the path of the 99%. This path is paved with FOMO, hype, and a complete disregard for the boundaries of competence. Let's revisit the dot-com era and look at the story of a company like Pets.com. The business model, on the surface, seemed simple: sell pet supplies online. But the underlying economics were a disaster that anyone operating within a circle of competence would have questioned. They were selling large, heavy bags of dog food at or below cost, and then spending a fortune on shipping. They spent millions on a Super Bowl ad featuring a sock puppet. Investors, caught in the mania, didn't ask the simple, critical questions. What is the unit economics here? How can you make money shipping a 40-pound bag of dog food for free? What is the durable competitive advantage when anyone can set up a website? Instead, they were swept up in the narrative of the new economy. They heard the jargon, first mover advantage, eyeballs, mindshare, and mistook it for a business strategy. They were operating far outside their circle of competence. They weren't investing in a business. They were betting on a ticker symbol attached to a popular idea. The result was a complete and total wipeout. The company went from IPO to liquidation in just 268 days. People who had poured their life savings into this and other similar companies, believing they were on the ground floor of the next Amazon, lost everything. This is the path of the 99%, chasing complexity they don't understand, buying stories instead of businesses, and mistaking a rising tide for their own genius. They ignore the simple, boring businesses in Box 1 because they aren't exciting enough, and instead, they gamble their capital in the murky depths of Box 3. The result is almost always the same: a portfolio built on sand, ready to be washed away by the first receding tide. The direct financial connection of adhering to a strict circle of competence is monumental, and it manifests most powerfully in two areas: capital preservation, and superior long-term returns. Let's look at the numbers from the dot-com bust. From the market peak in March 2000 to the bottom in October 2002, the Nasdaq 100 index fell by a staggering 78%. A $100,000 portfolio invested at the peak was worth just $22,000. To simply get back to even, that investor would need a 354% gain, a Herculean task that could take more than a decade. Now, look at Berkshire Hathaway. During that same period, Berkshire's stock price increased. Buffett didn't just avoid the loss, he generated a positive return while the market was in a freefall. The financial implication is staggering. As Charlie Munger famously says, the first rule of compounding is to never interrupt it unnecessarily. A single 80% loss requires you to quintuple your money just to break even. It can set your goal of financial freedom back by decades. By staying within his circle of competence, Buffett avoided that catastrophic interruption. This isn't just about one historical event. This principle of avoiding what you don't understand is the cornerstone of sound wealth management. On a company's balance sheet, simplicity often translates to clarity and predictability. A company like Wrigley's Gum has a balance sheet you can understand: inventory, receivables, property, plant, and equipment. A complex derivatives trading firm has a balance sheet filled with Level 3 assets, whose values are based on internal models, making them opaque and potentially fragile. By sticking to the former, you are building a portfolio on a foundation of tangible, understandable value, not on financial abstractions. The ultimate financial advantage is this: operating within your circle of competence dramatically reduces the risk of permanent capital loss. And since achieving significant capital gains is mathematically impossible if you've lost your initial capital, this defensive strategy is, paradoxically, the most powerful offensive weapon you have for long-term portfolio growth and building genuine, lasting wealth. Now we must turn our attention to a darker side of this equation. Simplicity is not just a tool for focusing your own mind. It is a shield against the minds of those who would actively seek to deceive you. This brings us to our second pillar: complexity as a cloak for deception. There is no greater, more chilling illustration of this principle than the story of a company that, for a time, was the seventh largest corporation in America. A company hailed as the pinnacle of innovation, whose executives were lauded as visionaries. A company called Enron. To understand Enron, you must first understand the atmosphere of the late 1990s. The company was the darling of Wall Street, consistently reporting smooth, predictable, and rapidly growing earnings. Its stock price soared. It was voted America's most innovative company by Fortune magazine for 6 consecutive years. Its CEO, Jeff Skilling, a brilliant and aggressive former McKinsey consultant, and its chairman, Ken Lay, a charismatic figure with deep political connections, were treated like rock stars. They preached a new gospel of business, one built on an asset-light strategy, trading everything from energy contracts to broadband width to weather derivatives. But if you asked a top analyst on Wall Street a simple question, how exactly does Enron make money? You would get a rambling, jargon-filled answer that left you more confused than when you started. They talked about synergistic platforms, risk management services, and unlocking hidden value. The truth was, almost no one really knew. The complexity was the entire point. It was a weapon. The foundational anecdote of Enron's deception begins with a young Fortune reporter named Bethany McLean. In early 2001, she was assigned a story on the company. Like everyone else, she started with the assumption that Enron was a great company, but as a good reporter, she began by reading their financial statements, their 10K report. And she was utterly baffled. The documents were a labyrinth of footnotes, off-balance sheet vehicles, and convoluted explanations. She couldn't figure out where the profits were coming from. She famously called a prominent hedge fund manager who was shorting the stock and asked him for his thesis. He simply said, "You're the reporter from Fortune. You tell me how they make money." She couldn't. This led her to a simple but explosive question, which became the title of her March 2001 article: Is Enron overpriced? In the article, she didn't accuse them of fraud. She simply pointed out the obvious. that the company's financials were impenetrably complex, and that its valuation made no sense based on the information that was publicly available. The backlash was immediate. Enron's management was furious. Skilling famously called her unethical for writing the article without being an expert on their business. But the seed of doubt had been planted. The core of Enron's fraud lay in two main areas of engineered complexity. The first was mark-to-market accounting. For a normal business, you book a profit when you receive cash. But Enron, with the approval of its auditors, was allowed to book the estimated future profit from a long-term contract the day it was signed. So if they signed a 20-year energy deal, they would use a complex internal model to guess what the profit would be over 2 decades and report all of that profit today, dimes. It was a license to print earnings out of thin air. The second and more sinister tool was the use of special purpose entities, or SPEs. These were thousands of off-balance sheet partnerships with names like Raptors and Jedi that Enron controlled. They used these entities to hide massive amounts of debt and to dump their losing assets. When a deal went bad, Enron would sell it to one of their SPEs, booking a phony profit and magically wiping the bad asset off its own books. It was a financial shell game of epic proportions, all hidden behind a wall of complexity so thick that it took a team of forensic accountants years to unravel. By the fall of 2001, the dam broke. The company was forced to restate its earnings, admitting that it had fabricated hundreds of millions of dollars in profits. The stock price, which had been over $90 a share, collapsed to less than $1, wiping out $74 billion in shareholder value. Thousands of employees lost not only their jobs but their entire life savings, which had been locked up in Enron stock in their 401k retirement plans. The smartest guys in the room were revealed to be nothing more than sophisticated criminals who had mastered the art of using complexity to conceal a simple, old-fashioned fraud. The Enron saga is a dramatic illustration of two powerful psychological principles that complexity exploits: the authority bias and social proof. Our brains are wired to take mental shortcuts, and one of the most common is to defer to the judgment of perceived authorities. In the case of Enron, the authorities were numerous and overwhelming. There was the company's own management, CEO Jeff Skilling and Chairman Ken Lay, who projected an aura of supreme confidence and intelligence. There were the Wall Street analysts from prestigious firms like Merrill Lynch and Goldman Sachs, who plastered strong buy ratings on the stock. There were the Big Five accounting firms, specifically Arthur Andersen, which was giving Enron's convoluted financials a clean bill of health year after year. And there were the politicians who sang the company's praises. When all these authority figures tell you that a company is a brilliant innovator, your brain's natural tendency is to shut down its own critical thinking and accept their verdict. The complexity of Enron's business model amplified this effect. Because no one could understand it, they assumed the authorities must. They thought, well, I don't get it, but these highly paid experts do, so it must be legitimate. This deference to authority was then supercharged by the principle of social proof, our tendency to assume that the actions of others reflect the correct behavior in a given situation. Every investor looked around and saw other investors buying Enron. They saw the stock price going up every month. They saw it celebrated in the financial press. This created a powerful feedback loop. The rising stock price was seen as proof that the business was sound, which encouraged more people to buy, which pushed the stock price even higher. The social consensus was so strong that it became career suicide for an analyst to question the company. Those who did were often ostracized or fired. The combination of impenetrable complexity, unwavering endorsement from authorities, and overwhelming social proof created a perfect storm. It paralyzed the collective financial immune system, allowing the virus of fraud to spread unchecked until the entire organism collapsed. The lesson is that complexity is the perfect breeding ground for these biases. It creates a vacuum of understanding that our brains rush to fill with trust in others, making us vulnerable to deception on a grand scale. To protect yourself from the next Enron, you need a practical mental model that acts as a fraud detector. You need a simple, repeatable process to cut through the fog of complexity. I call it the explain it to a child test. This isn't about being condescending. It's about forcing absolute clarity. Here is the 4-step blueprint. Step 1. Obtain the company's most recent 10K filing. This is their annual report, and it's freely available on the SEC's EDGAR database. Ignore the press releases. Ignore the flashy investor presentations. Ignore the CEO's interviews on television. Go directly to the source document. Step 2. Find the section at the beginning, usually called Item 1, Business. This is where the company is legally required to explain, in plain English, what it does. Read this section carefully, 2 or 3 times if necessary. Step 3. After reading, put the document aside and take out a blank piece of paper. Try to write down, in 1 or 2 simple sentences, how this company makes money. What product or service does it sell? Who are its customers? How does it get paid? Avoid all jargon. If the company leverages synergistic platforms to optimize human capital solutions, translate that. It probably means they sell HR software. If you cannot make this translation, you have found a massive red flag. Step 4. This is the most crucial step. Imagine you are explaining this company to an intelligent 12-year-old. Say it out loud. This company sees candies, makes chocolate in factories, and sells it in their own stores. People love the candy, so they can charge a little more for it every year, and that's how they make money. That's a pass. Now try it with Enron in 2000. Well, they buy energy contracts, and they also sell them, and they use something called mark-to-market accounting to estimate future profits, and they have these partnerships called SPEs that they sell assets to. You can hear the confusion in your own voice. You would fail the test, the child would be confused, and so should you be. If a business is so complex that you can't explain its fundamental economic engine in simple terms, you must assume one of 2 things is true. Either the business has no durable competitive advantage, or it is actively trying to hide something. In either case, your course of action is the same: walk away. This simple test, rigorously applied, would have saved you from Enron, from the Byzantine mortgage-backed securities of 2008, and from countless other investment disasters that were cloaked in the armor of complexity. The antithesis of this clarity-seeking approach is the path of the 99%, the path of blind trust. Let's look at the tragic story of the Enron employees. These were not Wall Street speculators. They were secretaries, engineers, and accountants who worked for the company every day. They were encouraged to invest their entire 401k retirement savings into Enron stock. They sat in company meetings where Ken Lay and Jeff Skilling, their trusted leaders, showed them chart after chart of ever-increasing earnings. They were presented with complex reports and assured that the company's innovative financial structures were the key to its success. They trusted the authority of their executives. They saw their colleagues getting rich on paper and were swept up in social proof. They never applied the explain it to a child test. They never asked the simple fundamental question, is this sustainable? They accepted the complexity as a sign of sophistication rather than a red flag. When the company collapsed, these employees were wiped out. Many who were on the cusp of retirement saw their multi-million-dollar nest eggs evaporate into nothing in a matter of months. They were left with worthless stock and a profound sense of betrayal. This is the ultimate danger of ignoring the simplicity test. It's not just about missing out on gains. It's about being exposed to catastrophic, life-altering losses. This same story repeats itself in different forms. The investors who bought into Bernie Madoff's Ponzi scheme did so because he had an air of authority, and his strategy was opaque. He told them he used a complex, split-strike conversion strategy. No one understood it, but the returns were good, so they didn't question it. They didn't demand a simple explanation. The result was financial ruin. The path of the 99% is to be impressed by complexity. The path of the intelligent investor is to be suspicious of it. The direct financial connection between complexity and fraud is not an abstract concept. It is written in the numbers on a company's financial statements. In Enron's case, the complexity was a direct mechanism for financial manipulation. Let's quantify it. The special purpose entities, these off-balance sheet vehicles, were used to hide over $1 billion in debt that should have been on Enron's balance sheet. This made the company look far healthier and less leveraged than it actually was. The mark-to-market accounting was used to inflate earnings by hundreds of millions of dollars. In the third quarter of 2001 alone, the company's unraveling forced it to take a $1.01 billion charge related to its complex partnerships and write down shareholder equity by $1.2 billion. The numbers were staggering. The complexity on the page was not just confusing, it was a direct representation of a financial lie. When you see a company whose cash flow statement and income statement are wildly divergent for long periods, it's a red flag. It often means the company is reporting paper profits that aren't being backed up by actual cash. When you see a balance sheet loaded with intangible assets like goodwill from a string of complex acquisitions, while tangible book value stagnates, it's a red flag. It might mean the company is overpaying for growth and destroying shareholder value. The lesson for your financial analysis is this: the simpler the financial statements, the more likely they are to be honest. A great business is often a simple one, and its financial health should be obvious from a clear and concise set of books. You want to see revenues that come from selling a real product or service, earnings that are backed by strong free cash flow, and a balance sheet with modest debt and tangible assets. Anything else, any financial engineering or accounting acrobatics, should be viewed not as a sign of sophistication, but as a potential sign of rot. Demanding this simplicity is a powerful form of financial education and a crucial part of your due diligence, protecting your capital from the catastrophic losses that fraud always leaves in its wake. Having established simplicity as a defense, we now pivot to its power as an offensive weapon. Great investments are not found in the complex and novel, but in the simple and enduring. This leads us to our third pillar, the durability of simplicity, the moat of understandability. A simple business is not necessarily a small or unsophisticated one. It is a business whose core value proposition is so clear and timeless that its future is highly predictable. The greatest competitive advantages, or moats as Buffett calls them, are often the ones that are easiest to understand. To see this principle in action, we need to travel back to 1972, to a decision that many of Buffett's sophisticated colleagues on Wall Street would have scoffed at. He and his partner, Charlie Munger, decided to buy a company called See's Candies for Berkshire Hathaway. On the surface, it was an utterly boring business. They manufactured and sold boxed chocolates, primarily in California. There was no disruptive technology, no complex algorithm, no revolutionary business model. They used old-fashioned recipes and sold their products in brick-and-mortar stores. Buffett and Munger paid $25 million for the company. At the time, it was earning about $4 million per year before taxes. From a purely quantitative perspective, it wasn't a screaming bargain. But what Buffett saw was not just a candy company. He saw a fortress of simplicity and durability. He understood the business model instantly. See's made a high-quality product that people loved. It was a traditional gift for holidays and special occasions. This created immense brand loyalty. Generations of families had grown up with See's chocolates. This loyalty gave the company something extraordinary: pricing power. Every year, after Christmas, the CEO of See's could raise prices by a small amount to cover inflation and then some, and customers would barely notice. They weren't just buying chocolate, they were buying nostalgia, tradition, and a guarantee of quality. The simplicity of the business made its future incredibly easy to forecast. Buffett knew that as long as they didn't mess with the quality, people would still be buying See's candies in 10, 20, and even 50 years. The competitive moat wasn't a patent or a secret formula. It was the simple, powerful idea of a beloved brand etched into the consumer's mind. The results of this simple investment have been nothing short of breathtaking. That initial $25 million investment has since returned over $2 billion in pre-tax earnings to Berkshire Hathaway, a return of more than 80-fold, not including the immense value of the business itself, which is still owned by Berkshire. See's Candies became Buffett and Munger's template for a great business, simple, understandable, with a durable brand that gives it pricing power. It taught them that you don't need to predict the future of technology to get rich. You just need to find a simple business that has already stood the test of time and bet on it continuing to do what it has always done. The underlying psychological principle that explains the power of See's Candies is known as the Lindy effect. The Lindy effect is a theory that the future life expectancy of some non-perishable things, like a technology or an idea, is proportional to their current age. In other words, for every day an idea or a technology survives, its expected lifespan increases. A Broadway play that has been running for 10 years is likely to run for another 10 years. A play that has been running for 1 week is unlikely to be around in a month. This principle applies powerfully to business models. A simple business that has been successfully selling the same basic product for 50 or 100 years, like Coca-Cola selling sugary water or Wrigley's selling chewing gum, is tapping into a basic, unchanging human desire. It has proven its resilience against recessions, wars, and technological change. It is Lindy. Therefore, the probability that it will still be around and profitable in another 50 years is incredibly high. Contrast this with a complex, new technology. A new social media app might be wildly popular today, but its model is built on shifting trends and technological platforms. It has not yet stood the test of time. Is it more likely that people will be using Facebook or drinking Coca-Cola in the year 2075? The Lindy effect would strongly suggest the latter. Simple businesses are often more durable because they are anti-fragile. They benefit from the chaos and change that destroys their more complex and rigid competitors. A simple, understandable business model focused on a timeless human need is the ultimate long-term investment. Investing in a Lindy business is a way of betting on human nature, which is a far more stable and predictable force than the trajectory of technological innovation. This is the core of a successful long-term investing strategy, finding simplicity that has endured, because that is where you will find the most predictable and profitable future. To translate this theory into a practical tool for your own investment strategy, you can use a mental model called the 10-year test. This is a simple thought experiment designed to assess the durability of a business's competitive advantage. It's a key part of your due diligence process. Here's the 3-step blueprint. Step 1. Clearly describe the business as it exists today. How does it make money? Who are its customers? What is its primary product or service? For example, BNSF Railway makes money by transporting physical goods, like coal, grain, and consumer products, across its vast network of tracks in North America for a fee. Step 2. Imagine the world 10 years from now. Don't try to predict specific stock prices or interest rates. Instead, think about the big, undeniable trends. Technology will be more advanced. The internet will be faster and more ubiquitous. There may be new cultural shifts. Now, ask yourself, how will these changes affect the business? For the railway, technology might make its operations more efficient, but will the fundamental need to move heavy goods across the country disappear? It's highly unlikely. Step 3. Now, ask the killer question. Is it highly probable that this business will be significantly larger, more profitable, and selling fundamentally the same service in 10 years? For a company like BNSF Railway or Waste Management, the answer is a resounding yes. We will need to move goods and dispose of trash in 10 years. For a company with a complex business model based on a current technological fad, the answer is much less certain. Will their products still be relevant? Will a new competitor have emerged with a better technology? The 10-year test forces you to distinguish between businesses with temporary advantages and those with truly durable moats. Simple, understandable businesses, those that provide basic goods and services, tend to pass this test with flying colors. This mental model is a powerful filter for your asset allocation, guiding you away from the exciting but fragile companies and toward the boring but indestructible ones that are the true engines of portfolio growth and wealth creation. The antithesis to this focus on durable simplicity is the path of the 99%, which is a relentless chase after the new and the disruptive. This path leads to a graveyard littered with companies that promise to change the world, but were built on complex, unproven, and ultimately fragile business models. Think back to the consumer 3D printing craze around 2013. Companies like 3D Systems and Stratasys were market darlings. The story was compelling. Soon, every home would have a 3D printer, and we would manufacture our own goods. It was a revolution, but the reality of the business was far more complex. The technology was difficult to use, the materials were expensive, and the use cases for the average consumer were limited. The companies had no clear, durable advantage. They were selling a complex technology into a market that wasn't ready for it. Investors who bought into the hype without applying the 10-year test were decimated. The stock prices of these companies collapsed by over 90% and have never recovered. They mistook a cool technology for a great business. Another example is Blue Apron, the meal kit company. The idea seemed revolutionary: deliver pre-portioned ingredients for chef-designed meals right to your door. But the underlying business model was incredibly complex and economically challenging. They faced enormous costs for customer acquisition, a logistical nightmare of refrigerated shipping, and intense competition from both other startups and traditional grocery stores that quickly started offering their own kits. The business had no moat. There was no brand loyalty that could create pricing power. As soon as a customer found a cheaper or more convenient option, they would switch. The company went public in 2017 at $10 per share. It now trades for pennies, having lost nearly all of its value. The 99% are drawn to these stories of disruption. They love the complexity and novelty because it makes them feel like they are on the inside of a new trend. But they fail to ask the simple, boring questions about durability, profitability, and competitive advantage. They are betting on maybes, on futures that are highly uncertain, while ignoring the certainties offered by simple, proven business models. The direct financial connection between simplicity and durability is one of the most powerful forces in building wealth. Predictable, growing free cash flow. Free cash flow is the lifeblood of a business. It's the cash left over after all expenses and investments are paid, and it's what can be used to pay dividends, buy back stock, or make acquisitions, all things that directly increase shareholder value. Simple, durable businesses are cash-generating machines. Let's look at the financial statements of a company like Hershey's. For decades, it has produced a consistent and growing stream of free cash flow. There are no wild swings, no years of massive losses. The simplicity of its business model, selling branded chocolate, translates directly into a predictable and reliable line item on its cash flow statement. This predictability is what allows an investor to confidently value the business and project its future returns. Now compare that to a speculative, high-complexity tech company. Its cash flow statement is often a horror show of negative numbers. It is burning through cash every quarter to fund its growth, with the mocks of one day becoming profitable. Investing in such a company is a bet on a distant, uncertain future. The financial impact of choosing the simple, cash-generative business is profound. The steady stream of cash allows the company to relentlessly compound its value. It can buy back its own shares, which increases your ownership stake and earnings per share. It can pay a growing dividend, providing you with a direct cash return. Over time, these seemingly small, boring actions, funded by predictable cash flow, are what lead to massive capital gains. A durable, simple business is a financial compounding machine. The simplicity of the model is not just an aesthetic preference. It is the very engine of its long-term financial performance. When you invest in an understandable business, you are investing in a future stream of cash that you can see and quantify, which is the most reliable path to financial independence. We have explored simplicity in the business model, but there is another, equally crucial dimension: simplicity in communication. This brings us to our fourth pillar, the CEO litmus test. Warren Buffett has famously said that he reads the annual reports of hundreds of companies every year. He is not just looking for numbers. He is looking for something far more subtle, but infinitely more important. He is judging the character and clarity of mind of the CEO. How a leader communicates, Buffett believes, is a direct reflection of how they think. A CEO who writes with clarity, honesty, and simplicity is likely a leader who thinks with clarity, honesty, and simplicity. A CEO who hides behind jargon, corporate speak, and obfuscation is likely a leader with a muddled strategy, or worse, something to hide. The foundational anecdote for this pillar is not about a company Buffett invested in, but about the company he runs. The annual letters to shareholders of Berkshire Hathaway, written by Warren Buffett himself, are masterpieces of the genre. They are required reading at business schools not just for their investment wisdom, but for their extraordinary style. Buffett takes incredibly complex subjects, like the economics of the insurance business, and explains them using simple, relatable analogies. He once described the concept of insurance float, the cash that an insurance company holds between collecting premiums and paying claims, as being like having a bank account where, instead of paying you interest, you get to keep the money and invest it for yourself. In a few simple sentences, he illuminated a concept that entire textbooks failed to clarify. He is also brutally, refreshingly honest. He begins every letter by reporting the change in Berkshire's book value versus the S&P 500, the yardstick he asks his shareholders to judge him by. In years when he underperforms, he says so up front and explains why. He famously dedicated a large portion of one letter to detailing his, quote, mistakes of the year, such as his disastrous purchase of Dexter Shoe Company, which he admitted destroyed billions in shareholder value. He doesn't blame the market or bad luck. He takes personal responsibility. Contrast this with the typical corporate annual report. It is often a glossy, self-congratulatory marketing document filled with impenetrable prose. CEOs talk about leveraging our core competencies to execute a paradigm shift in our go-to-market strategy. This is not communication, it is anti-communication. It is designed to sound impressive while saying nothing. Buffett's letters are the opposite. They are a direct, honest, and educational conversation with his business partners, the shareholders. He believes that if you can't explain what you're doing in simple language, you probably don't know what you're doing. And if a CEO can't or won't be clear with you, you should not entrust them with your capital. The psychological principle that makes this test so effective is the fluency heuristic. Our brains are lazy. They prefer to process information that is simple, clear, and easy to understand. This cognitive ease creates a feeling of familiarity, trust, and truth. When we read a sentence that is written in plain, direct English, our brain processes it fluently, and we are more likely to believe it and trust the person who wrote it. Conversely, when we encounter information that is complex, filled with jargon, or awkwardly phrased, it creates cognitive strain. Our brain has to work harder to decipher the meaning. This strain triggers a subtle feeling of suspicion and distrust. We intuitively feel that the writer might be incompetent, or perhaps trying to deceive us. A CEO who writes like Warren Buffett is creating cognitive ease. They are building trust at a subconscious level. Their clear language makes us feel like they are smart, competent, and have nothing to hide. A CEO who uses corporate speak is creating cognitive strain. Their convoluted language makes us feel uneasy. We might not be able to pinpoint exactly why, but our brain is sending a signal. Warning: this is difficult to process. Proceed with caution. The CEO litmus test is a way of consciously using this heuristic to your advantage. You are actively looking for the feeling of fluency as a proxy for trustworthiness and clarity of thought. The CEO mindset you want to invest in is one of a teacher, someone who genuinely wants their partners to understand the business. The mindset you want to avoid is that of a magician, someone who uses complex language to create an illusion and protect their secrets. By paying attention to the style of communication, not just the substance, you can gain a powerful insight into the quality of the leadership team running the company, which is a critical element of any intelligent investment. To make this a repeatable part of your financial analysis, you can use a mental model I call the annual letter grader. This is a simple scorecard you can use to evaluate a CEO's annual letter to shareholders and get a quick read on the quality of their leadership and communication. The scorecard has 4 categories, each rated on a scale of 1 to 10. Category 1, the clarity score. Read a few paragraphs of the letter. Is the CEO using plain English, or is it filled with business jargon? Do they use simple analogies to explain complex topics? A high score here goes to leaders who sound like a human being having a conversation. A low score goes to those who sound like a corporate robot. Category 2, the honesty score. Does the CEO openly discuss challenges, setbacks, and mistakes from the past year? Or is the letter a pure marketing document where everything is perfect and the future is always bright? A high score is for leaders who treat their shareholders like partners and are willing to be vulnerable and accountable. A low score is for those who are clearly spinning a narrative. Category 3, the focus score. What does the CEO spend the most time talking about? Are they focused on the long-term fundamentals of the business, product quality, customer satisfaction, competitive advantages, and capital allocation? Or are they obsessed with short-term metrics, like the quarterly stock price, or meeting Wall Street's earnings estimates? A high score goes to a CEO with a long-term owner's mindset. A low score goes to a CEO who is managing the stock price instead of the business. Category 4, the educational score. After reading the letter, do you feel like you have a better and deeper understanding of the business and the industry it operates in? Or do you feel more confused? The best CEOs are teachers. Their letters should leave you feeling smarter. A high score means you learned something valuable. A low score means you just wasted your time. After grading the letter, add up the scores. A company with a CEO who scores in the 30s or 40s is likely a well-led organization with a culture of transparency and rational thinking. A CEO who scores in the 10s or low 20s is a major red flag. This simple grading system turns a subjective feeling into a quantifiable data point, providing a powerful filter for your executive decision-making as an investor. The antithesis of Buffett's clear communication is the path of the 99% of corporate leaders who rely on a fog of corporate speak. This language is not just bad writing, it is a tool used to mask a lack of strategy, to obscure poor performance, and to avoid accountability. Let's consider a few examples. When a company is in trouble, you will rarely hear a CEO say, "We made a bad product, and our sales are falling." Instead, they will say, "We are currently experiencing headwinds in a challenging macroeconomic environment, and we are right-sizing the organization to align our cost structure with current demand." Right-sizing is a cowardly euphemism for firing people. Headwinds is a way of blaming external forces instead of internal failures. When a CEO can't articulate a clear strategy for the future, they will say something like, "Our forward-looking strategy is to leverage our best-in-class assets to unlock synergistic value across our global platform." This is a sentence that is grammatically correct but utterly devoid of meaning. It is a smokescreen. It's designed to sound impressive to people who aren't paying close attention. This was the language of the CEOs at companies like General Electric in its decline, or at Yahoo during its slow-motion collapse. They produced beautiful annual reports filled with vague platitudes about innovation and synergy, but they couldn't clearly articulate how they were going to compete and win. The language was a symptom of a deeper disease, a lack of clear thought, and a broken business model. Investors who are seduced by this language, who mistake jargon for intelligence, are walking into a trap. They are investing in a story, not a reality. The path of the 99% is to be impressed by this verbal gymnastics. The path of the intelligent investor is to recognize it for what it is, a giant, waving red flag signaling that the leadership either doesn't know what they're doing or they don't want you to know what they're doing. The direct financial connection between clear communication and shareholder returns is found in the critical function of capital allocation. A CEO's most important job is to decide what to do with the company's profits. They have 5 basic options. 1. Reinvest in the existing business. 2. Make acquisitions. 3. Pay down debt. 4. Pay a dividend. Or 5. Buy back stock. The decisions they make here have a monumental impact on long-term returns. A CEO who thinks and communicates with clarity is far more likely to make rational, value-enhancing capital allocation decisions. Their clear understanding of the business and its competitive position allows them to identify the highest return opportunities. They will only reinvest in projects that promise a high rate of return, they will only make acquisitions at sensible prices, and they will return capital to shareholders when they can't find better uses for it internally. This is the essence of great executive decision-making. Conversely, a CEO whose mind is muddled, as evidenced by their muddled language, will make muddled capital allocation decisions. They will fall prey to empire building, making overpriced acquisitions to grow the company for the sake of growth. They will throw good money after bad, reinvesting in failing business lines out of ego. They will squander cash on vanity projects. This confusion and irrationality directly destroys shareholder value. The CEO's annual letter is your single best window into their capital allocation philosophy. If they can clearly explain their framework for these decisions, using simple language and logical reasoning, you can have confidence that they will be a good steward of your capital. If their discussion of capital allocation is vague or non-existent, you should assume they have no coherent strategy, and your investment will suffer as a result. The clarity of the prose in the annual report has a direct, causal link to the growth of cash in your brokerage account. We have now come to the final and perhaps most important pillar of our exploration. It is the pillar that explains why we are so susceptible to the allure of complexity in the first place. We must understand the enemy within our own minds. This is Pillar 5, the cognitive cost of complexity. Your brain on jargon. To fully grasp this, we must examine one of the most terrifying financial meltdowns in modern history, a story of intellectual hubris so profound that it nearly brought the entire global financial system to its knees. This is the story of long-term capital management, or LTCM. LTCM was not a company of fools. It was, by any measure, the most brilliant collection of financial minds ever assembled under one roof. The firm was founded in 1994 by John Meriwether, the legendary former head of bond trading at Salomon Brothers. But the real stars of the show were its partners, who included two Nobel Prize-winning economists, Myron Scholes and Robert C. Merton. These were the men who had literally written the book on how to price financial options. Their mathematical models were the foundation of modern finance. Their strategy was intoxicatingly complex. They used sophisticated computer models to identify tiny temporary pricing discrepancies in global bond markets. For example, they might notice that a 29.5-year U.S. Treasury bond was trading for a fraction of a penny less than a 30-year bond. Their models told them that, eventually, these prices had to converge, so they would buy the cheap one and sell the expensive one. The profit on any single trade was minuscule, but their solution was simple: leverage. They borrowed massive amounts of money from every major bank on Wall Street to amplify their bets. For every dollar of their own capital, they were borrowing and trading with more than $25, and that was just the on-balance sheet leverage. Their use of complex derivatives pushed their true economic leverage to over 100 to 1. For a few years, it worked like magic. They generated returns of over 40% per year. They were the kings of the financial universe, hailed as geniuses who had created a money-printing machine. Their models were so complex, so filled with Greek letters and advanced calculus, that no one, not even the banks lending them billions, fully understood them. But they didn't need to. They just needed to believe in the Nobel laureates. Then, in the summer of 1998, the unthinkable happened. Russia defaulted on its domestic debt. This was a Six Sigma event, something their models predicted would happen only once in the history of the universe. But it happened. The event triggered a global flight to safety. Investors around the world dumped all risky assets and piled into the most liquid, safe U.S. Treasury bonds. The tiny price discrepancies that LTCM was betting on to converge suddenly violently diverged. Every single one of their trades went against them, all at the same time. Because of their immense leverage, the small losses became catastrophic. In a matter of weeks, they lost $4.6 billion, nearly all of their capital. The firm was on the verge of collapse, and because they were so intertwined with every major bank, their failure threatened to trigger a chain reaction that would crater the global financial system. The Federal Reserve had to orchestrate an unprecedented $3.6 billion bailout by a consortium of Wall Street banks to unwind their positions and prevent a worldwide meltdown. Warren Buffett was even called in as a potential last-minute savior. The smartest guys in the room, armed with the most complex models ever devised, had failed in the most spectacular way imaginable. They had built a system so complex they couldn't see its fatal flaw. It was all built on the assumption that the future would look like the past and that human panic was something their models could control. The psychological story of LTCM is a cautionary tale about two of our most dangerous mental flaws: the expert problem and confirmation bias. The expert problem, also known as the authority bias we discussed earlier, is our deep-seated tendency to put blind faith in credentialed experts. Myron Scholes and Robert Merton weren't just experts, they were Nobel laureates. Their intellectual authority was so immense that it created a reality distortion field. The highly paid risk managers at the banks lending them money were intimidated. They saw the complex equations, and rather than admitting they didn't understand them, they simply deferred to the geniuses. They assumed that if Nobel Prize winners said the risk was managed, then the risk was managed. This is the danger of intellectual outsourcing. When we encounter a subject that is sufficiently complex, we stop thinking for ourselves and simply trust the expert. This is a rational shortcut in many areas of life. You trust your surgeon to perform surgery. But in finance, where the expert's incentives may not be aligned with yours, it can be fatal. Once the banks and investors were committed to LTCM, a second bias took over: confirmation bias. This is our tendency to search for, interpret, and recall information in a way that confirms our pre-existing beliefs. Every month that LTCM produced high returns, it was seen as powerful confirmation that the models worked, and the geniuses were right. The mounting risks, like their ever-increasing leverage and their growing concentration in illiquid markets, were ignored or rationalized away. The evidence that contradicted the genius narrative was systematically filtered out. The investors and bankers were not looking for the truth. They were looking for reassurance that their initial decision was correct. Complexity feeds this bias perfectly. Because the underlying strategy is a black box, it's impossible to independently verify. You are forced to rely on the curated results presented by the experts. When those results are good, your belief is confirmed. When the first signs of trouble appear, the complexity provides a convenient excuse. Oh, it's just short-term market volatility. The long-term models are still valid. LTCM is the ultimate proof that IQ and rationality are not the same thing. The partners at LTCM were geniuses, but their belief in their own complex models was so absolute that it blinded them to simple, common-sense risks. To defend against the seductive danger of intellectual outsourcing, you need a mental model that forces you to confront the potential downsides of complexity. You need to use the powerful technique of inversion, a favorite tool of Charlie Munger. Instead of asking, "How can this complex strategy succeed?" you invert the question and ask, "What are all the ways this complex strategy could fail?" This is the inversion test for complexity. Here is the blueprint for applying it. Step 1. Identify the core assumptions of the complex business or investment strategy. You must force yourself to articulate the one or two key beliefs upon which the entire thesis rests. For LTCM, the core assumptions were: 1. Historical correlations between different bond markets will persist into the future. And 2. We will always be able to trade in and out of our positions because markets will remain liquid. Step 2. Systematically and ruthlessly attack each assumption. For each one, ask, what if the exact opposite happened? What if historical correlations broke down completely during a panic? What if liquidity in our key markets dried up, and we couldn't sell our positions at any price? This is not about predicting that these things will happen. It's about exploring the consequences if they do. Step 3. Quantify the impact of failure. If assumption number 1 fails, what happens to our portfolio? If assumption number 2 fails, what happens? For LTCM, the answer was simple. Failure of either assumption, magnified by 100-to-1 leverage, would lead to total and immediate ruin. The inversion test for complexity acts as a stress test for your ideas. It shifts your focus from the potential upside, which is often easy to imagine, to the hidden points of failure. When a strategy is simple, the failure points are usually obvious. For See's candies, the primary point of failure is if they ruin the brand's reputation for quality. It's a knowable, manageable risk. For a complex hedge fund strategy, the failure points are often hidden within the assumptions of the model itself. By inverting the problem, you drag these hidden risks out into the light of day. It is one of the most powerful tools in your arsenal for developing a superior investment strategy and avoiding the permanent capital loss that comes from a brilliant but fragile idea. The antithesis of this rational, risk-focused approach is the path of the 99%, embodied by the day trader who is mesmerized by a universe of self-proclaimed complexity. This is the individual who believes they have found the secret to beating the market not in business fundamentals, but in deciphering complex patterns on a stock chart. Their world is filled with esoteric tools like Fibonacci retracements, Gann angles, Elliott wave theory, and MACD indicators. They have multiple screens filled with flashing charts and believe they are engaged in a sophisticated form of analysis. In reality, they are a victim of what Nassim Taleb calls the ludic fallacy, the mistake of applying the neat, clean rules of a game to the messy, unpredictable real world. They are creating an illusion of control. The complexity of their charts and indicators makes them feel like they have a special knowledge, an edge over the average person. It feels like science, but it is a distraction from the one thing that actually matters, the underlying value of the business. This trader spends zero time reading a 10K, analyzing a balance sheet, or assessing a company's competitive moat. They are not investing. They are gambling on price wiggles. This path rarely, if ever, leads to financial freedom. It is a path that primarily enriches brokers through constant trading commissions and the sellers of secret trading systems. The complexity here is not a tool for understanding. It is a narcotic. It provides a feeling of intellectual engagement and excitement, while completely detaching the user from the economic reality of the business they are trading. It is the ultimate rejection of Buffett's simple, powerful insight that a stock is not a blinking symbol on a screen, but a small piece of ownership in a real business. The direct financial connection between complexity and the risk of ruin is a single terrifying word: leverage. Complexity and leverage are a diabolically dangerous combination. A simple, understandable business can be leveraged responsibly. You can take out a mortgage on a house because you understand its value and the rental income it can generate. But when you apply leverage to a complex, opaque, black box strategy, you are creating an instrument of potential self-destruction. Let's return to the numbers of LTCM. They had an on-balance sheet assets-to-equity ratio of over 25:1, but their use of off-balance sheet derivatives created an effective leverage of over 100:1. This means that a mere 1% drop in the value of their assets would be enough to wipe out 100% of their equity. A simple investment strategy has a wide margin of safety. If you buy a great simple business at a fair price, it can decline 20% or 30% in a market downturn, and you will not be wiped out. You own a piece of a durable, cash-producing asset, and you can afford to wait for its value to be recognized. A complex, leveraged strategy has no margin of safety. A small error in the model, a small change in market conditions, can trigger a margin call that forces you to liquidate your positions at the worst possible time, turning a temporary paper loss into a permanent, catastrophic loss of capital. This is the financial lesson etched in the tombstone of LTCM. The more complex an investment strategy is, the less leverage you should apply to it. In fact, for most investors, any strategy so complex that its risks are not immediately and intuitively obvious should have zero leverage applied to it. Simplicity allows for mistakes. It allows for bad luck. It allows for the unpredictable nature of markets. Complexity, when combined with leverage, demands perfection. And in the world of finance, perfection does not exist. Ignoring this connection is a direct path to financial disaster and the antithesis of sound wealth management. You have made it to the end of this journey, and in doing so, you have invested something far more valuable than money: your time and your attention. What you have acquired in return is not a collection of facts, but a powerful new filter for your mind. You have learned to see simplicity not as a sign of naivete, but as the ultimate form of sophistication. You have learned that the most profitable question is often the simplest one. Do I understand this? You now possess the mental framework to define your circle of competence, to use simplicity as a shield against fraud, to identify the durable, understandable businesses that build lasting wealth, to judge leaders by the clarity of their words, and to recognize the cognitive traps that make us fall for the allure of complexity. This simplicity filter is a permanent upgrade to your mental software, a tool that will protect your capital and guide you toward more rational, more profitable decisions for the rest of your life. But you must understand that this powerful tool, as critical as it is still just one piece of a much larger puzzle. The complete system of thought used by the world's greatest investors is a network of interconnected mental models. The simplicity filter helps you decide where to look for investments, but it doesn't tell you what price to pay. It helps you avoid the bad businesses, but it doesn't give you the tools to precisely value the great ones. It is a map of the treacherous coastlines, showing you where the rocks and shoals are, but you still need the compass and the sextant to navigate the open ocean. The video that is now appearing on your screen is that next piece of the map. It is the crucial link that connects the principle of simplicity to the practice of valuation. It is the tool that allows you to take an honest, simple company and determine if it's a bargain, a fair deal, or a speculative trap. A casual viewer stops here, satisfied with the knowledge they've gained, and that is fine. But you are not a casual viewer. The very fact that you have come this far proves that you are part of a different group. You are an architect of your own financial future, an intelligent investor committed to building a complete mental arsenal. You understand that mastery is not a single event, but a continuous process of layering one piece of wisdom upon the next. The journey to financial independence is an ascent, and you have just reached a vital base camp. The next stage of that ascent, the next piece of your intellectual toolkit, is waiting for you. Do not break your momentum. Continue the climb. Complete the map. Click on the next video and take the next step toward mastering the art of rational investment.